All right, welcome everyone to another deep dive. Today, we're tackling something that I know a lot of people find kind of intimidating, maybe even a little scary: investing.
Yeah, it can definitely seem overwhelming, especially when you're just starting out. I mean, where do you even begin? Do you need a ton of money? What if you mess up and lose everything?
Exactly. And those are precisely the questions we're going to unpack today. We're diving into a beginner's guide to investing, a roadmap designed to demystify this whole world and get you on the path to growing your money wisely.
Our mission today is to take you from feeling lost and intimidated to feeling empowered and confident about taking those first steps in investing.
Love that. So let's start with the most basic question. Why bother investing at all? Why not just stash your cash in a savings account and call it a day?
Well, here's the thing. Just saving money, especially in a low-interest savings account, can actually mean you're losing money over time. The culprit: inflation.
Inflation, that sneaky thief that makes everything more expensive.
Exactly. Our guide uses a simple example. Something that cost, say, $100 10 years ago would probably cost you closer to $130 today. And if your savings account is only giving you, let's say, 0.5% interest, you're not even keeping pace with that.
Right. So your money is actually shrinking in terms of its buying power. That's where investing comes in. You're essentially putting your money to work to grow faster than inflation.
And the key to making that happen, it's this powerful concept called compound growth.
Compound growth. It almost sounds too good to be true.
It can feel kind of magical, but it's very real. Basically, it's like your earnings start earning their own earnings. Like imagine rolling a snowball down a hill. It gets bigger and bigger as it picks up more snow.
Okay, I'm picturing it. But how does this actually play out with investments?
Well, the guide gives us this really cool illustration. Let's say you invest $1,000 and you manage to get an average annual return of 8%. After 10 years, that $1,000 could potentially grow to over $2,000. Extend that to 20 years, and you're looking at maybe $4,500. And get this, after 30 years, that initial grand could potentially balloon to over $10,000.
Whoa, 10,000 from just one. That really highlights the power of starting early, even if it's with a modest amount.
Absolutely. The more time your money has to compound, the more impressive the result can be down the road.
Okay, so we're convinced investing is the way to go. But before we even start picking stocks or bonds or whatever, what are the essential steps to take to make sure we're actually ready to invest?
That's a great question. And our guide stresses the importance of laying a solid financial foundation before diving into the investment world. It's all about getting your financial house in order.
So what are the key pillars of this financial foundation?
Well, the first one is crucial: an emergency fund.
Yeah, that makes sense. Life throws curveballs.
Yeah.
And you don't want to be forced to sell your investments at a bad time just to cover an unexpected expense.
Exactly. The guide recommends having at least 3 to 6 months worth of your essential living expenses saved up in a readily accessible account. That way, if your car breaks down or you face a sudden job loss, you're not dipping into your investments.
Okay, so emergency fund. Check. What's next?
The next big one is tackling any high-interest debt you might have, like credit card debt, for example.
Oh yeah, those credit card interest rates can be brutal.
Totally. And our guide points out that it's unlikely your investment returns will consistently outpace those sky-high interest rates. So it makes sense to prioritize paying down that high-interest debt first. It's like trying to fill a leaky bucket. You got to fix the leak before you can start filling it up.
Love that analogy. So emergency fund, high interest debt. What's the third element?
Budgeting. Plain and simple, you gotta know where your money is going. It's essential to have a clear picture of how much you can realistically set aside for investing on a regular basis, even if it's a small amount.
Consistency is key, right? Even small amounts invested regularly can add up over time.
Exactly. And finally, it's crucial to set clear goals for your investing. What are you trying to achieve? Retirement, buying a house, funding your kids' education.
Yeah, your goals are going to significantly shape the types of investments you choose and your overall investment strategy.
Absolutely. It's about aligning your investments with your life goals and your time frame.
So once you've got those 4 pillars sorted, emergency fund, high interest debt, budgeting, and clear goals, you're in a much stronger position to start investing. So let's dive into the fun part, the actual investment options. Where can you put your money to work?
Okay, so the guide lays out some of the most common types of investments that are generally considered good for beginners. First up, we have stocks.
Stocks. Those represent ownership in a company, right? Like if you buy a share of Apple stock, you own a tiny piece of Apple.
Precisely. And stocks offer the potential for high growth, but they also come with a higher level of risk compared to some other options. Their value can fluctuate quite a bit.
Okay, so stocks are kind of the high growth, higher risk option. What about something a little more, well, steady?
That's where bonds come in. Bonds are essentially loans you make to companies or governments.
So you're lending them money and they pay you interest.
That's the gist of it. Bonds tend to be less risky than stocks, but they also typically offer lower potential returns. They can be a good way to add some stability to your investment portfolio.
Got it. So we have stocks for potential growth and bonds for stability. Now, the guide also mentions something called index funds. What are those all about?
Index funds are super popular, especially among beginners. They're like baskets of stocks that are designed to track a specific market index, like the S&P 500.
So instead of buying individual stocks, you're buying a whole bunch of them in one go.
Exactly. And that gives you instant diversification, which means you're spreading your risk across many different companies. Index funds also tend to have low fees, which is great.
Okay, index funds, low fees, diversification. I'm liking it. Now, the guide also mentions something called ETFs. What's the difference between an index fund and an ETF?
They're very similar in that they often track a specific index or sector, but the main difference is how they're traded. ETFs are traded on stock exchanges just like individual stocks, so you can buy and sell them throughout the trading day. Index funds, on the other hand, are typically priced once a day.
Ah, so ETFs give you more flexibility in terms of when you buy and sell.
Mhm.
Got it. What about mutual funds? How do those fit in?
Mutual funds are professionally managed portfolios of stocks, bonds, or other assets.
So you're basically handing over the reins to a professional to make the investment decisions for you.
Yep. Mutual funds can be a good option if you prefer a more hands-off approach, but it's important to note that they can sometimes have higher fees associated with that professional management.
All right, mutual funds, professional management, might come with higher fees. The guide also mentions something called REITs. What are those?
REITs, or real estate investment trusts, allow you to invest in real estate without actually buying physical properties.
So it's like owning a piece of a shopping mall or an office building without having to deal with tenants and repairs and all that.
Exactly. REITs own and operate income-producing real estate, and you can buy shares in them to gain exposure to the real estate market.
Interesting. So we've got stocks, bonds, index funds, ETFs, mutual funds, REITs. The guide also briefly mentions crypto and other alternative investments.
Yeah, and it's important to remember that those tend to be much riskier and can experience wild price swings. They might not be the best starting point for new investors.
Okay, so when you're first starting out, the key is to keep things simple and stick with the more established investment options.
Exactly. The guide encourages beginners to focus on building a solid foundation with a diversified portfolio of low-cost investments. Don't get lured in by the hype or try to overcomplicate things.
Great advice. Now let's talk about risk. It's a word that gets thrown around a lot in the investment world. So help us understand this. What exactly is risk when it comes to investing?
Risk is basically the possibility that your investments could lose value. It's the uncertainty inherent in any investment.
So there's no such thing as a risk-free investment.
Well, some investments are considered very low risk, like government bonds, for example. But even those carry a tiny bit of risk.
Okay, so risk is a part of the game. But how do you know how much risk you're comfortable taking on?
The guide lays out two crucial questions to consider. First, how much of a potential loss can you handle, both financially and emotionally? And second, when will you need to access the money you're investing?
Right, so if you're investing for a long-term goal, like retirement, you might be okay with taking on more risk because you have time to ride out any market ups and downs.
Exactly. But if you need that money in a few years for a down payment on a house, you'll probably want to choose more conservative, lower risk investments.
Makes sense. The guide also talks about something called emotional risk. What's that all about?
Emotional risk is about how you react to the inevitable fluctuations in the market. It's about staying calm and rational when your investments go down in value and avoiding making impulsive decisions based on fear or panic.
Yeah, I can see how that's super important. It's easy to get swept up in the emotions of the market.
Totally. And that's where having a well-defined investment plan and understanding your own risk tolerance really comes in handy.
So we've covered risk. Now let's talk about some common mistakes that new investors tend to make.
Yeah, the guide highlights some pitfalls to watch out for. One big one is trying to time the market.
Trying to predict when to buy low and sell high, it sounds tempting, but
But it's incredibly difficult to do consistently, even for professionals. A much more effective strategy is to simply invest consistently over time, regardless of what the market is doing at any given moment.
so it's about time in the market, not timing the market.
Got it.
Yeah.
What other mistakes do beginners often make? chasing hot stocks or trends, getting caught up in the hype and investing in something simply because everyone else is talking about it.
Like those meme stocks we saw a while back, or jumping on the latest crypto craze.
Exactly. It's important to remember that what's popular isn't necessarily a good long-term investment. The guide also cautions against ignoring fees.
Ah, yes, fees. Those sneaky little charges that can eat into your returns.
Yep. It's crucial to pay attention to the fees associated with any investment you're considering and to choose low-cost options whenever possible. Index funds and ETFs are generally good in this regard.
Another mistake the guide mentions is lack of diversification.
Right, not putting all your eggs in one basket. It's about spreading your investments across different asset classes like stocks, bonds, and maybe even real estate, as well as across different sectors within those asset classes.
So if one investment tanks, it doesn't take your whole portfolio down with it.
Precisely. And another common mistake is panic selling. Selling your investments when the market takes a dip because you're afraid of losing even more money.
Yeah, I can see how that's tempting, but
But it often means locking in those losses. Remember, market downturns are a normal part of the cycle. Having a long-term perspective is key.
And finally, the guide emphasizes the importance of having a plan.
Absolutely. Investing without a clear roadmap, without defined goals, can lead to impulsive decisions and ultimately undermine your success.
So avoid those common pitfalls, and you'll be well on your way to a successful investing journey. Now let's get practical. You've done your homework, you're ready to invest. What are the actual steps to get started?
All right. Step 1, according to our guide, is to open an investment account. This is where you'll hold your investments. There are many reputable online brokerage platforms out there like Fidelity, Vanguard, Charles Schwab, Robinhood, and Wable.
And as the guide points out, they all have their own strengths and weaknesses, so it's worth doing some research to see which one aligns best with your needs.
Once you've got your account set up, you need to choose your investment strategy. For beginners, the guide recommends starting with a simple, diversified portfolio.
Like that 80-20 split we talked about earlier, 80% in low-cost stock index funds and 20% in bond index funds.
Exactly. That's a good starting point for someone with a long time horizon and a moderate risk tolerance. But of course, you can adjust that based on your individual circumstances and goals. The guide also stresses the importance of automating your contributions.
Ah, yes. Setting up those automatic transfers from your bank account, that takes the guesswork out of it and helps you stay disciplined.
For sure. And if you have access to tax-advantaged accounts like a 401k through your employer or a Roth IRA, definitely take advantage of those. The tax benefits can really add up over time.
And once you started investing, don't just set it and forget it. The guide recommends reviewing and rebalancing your portfolio periodically.
Right. Rebalancing basically means adjusting your investments to make sure you're still on track with your original strategy and your desired level of risk. Like if your stocks have performed really well, you might need to sell some and buy more bonds to bring things back into balance.
So it's about keeping an eye on things and making adjustments as needed.
Got it. And the most important step of all.
Just start, even if it's with a small amount. Don't let fear or perfectionism hold you back. The magic of compounding works best when you give it time.
Absolutely. Take that first step and keep learning and growing as you go. Now, before we wrap up, I want to touch on something that our guide emphasizes, the psychology of investing.
Yeah, this is a really important aspect that often gets overlooked. Investing isn't just about numbers and spreadsheets. It's also about understanding your own emotions and behaviors.
It's about how you react to market fluctuations, how you handle risk, and whether you can stay disciplined and focused on your long-term goals.
Successful investors are often those who can control their emotions, resist impulsive decisions, and stick to their plan even when things get bumpy.
So it's not just about being financially savvy. It's also about being emotionally intelligent. Now, finally, the guide points to some interesting trends shaping the future of investing. What are some of those? One big trend is the rise of robo-advisors. These are automated platforms that use algorithms to build and manage investment portfolios based on your goals and risk tolerance. They can be a great option for beginners who prefer a hands-off approach.
The guide also mentions fractional shares, which allow you to buy a portion of a share of stock, even if you can't afford a whole share. This opens up investing to people with less capital.
Another interesting trend is the growing focus on socially responsible investing, or ESG investing. This is about aligning your investments with your values, considering environmental, social, and governance factors alongside financial returns.
And of course, we can't forget about cryptocurrencies. The guide mentions crypto ETFs, which are starting to emerge as a way to gain exposure to the crypto market through a more traditional investment vehicle.
And then there's decentralized finance, or DeFi, which is still in its early stages but has the potential to revolutionize the way we think about finance and investing.
It's a lot to keep up with, but it's exciting to see how the investment landscape is evolving and becoming more accessible to everyone.
Absolutely. So to sum it all up, we've covered why investing matters, how to prepare yourself financially, the key investment options, how to manage risk, common mistakes to avoid, and the importance of understanding your own investment psychology.
We've also touched on some of the exciting trends shaping the future of investing. And remember, the most important step is to just get started.
Take action, be consistent, stay informed, and don't be afraid to ask for help along the way. The world of investing might seem intimidating at first, but with the right knowledge and mindset, you can achieve your financial goals.
Couldn't have said it better myself. Your money can work as hard for you as you work for it, so make it happen. Thanks for joining us for this deep dive into the world of investing.
It's been a pleasure.
We'll see you next time.